And we are back. I'm glad to bring back my favorite guest. He is the Kevin Peranio, who is the Chief Lending Officer of, I'd say, top 50 lender, $5 billion a year origination flow, PRMG. And, I'm so happy to have him back because I'm addicted to his LinkedIn videos. I listen to every one of them, Kevin, so no secrets from me. I know everything that's going on. Yeah, I know.
All right, and thank you.
But there's tons of stuff to talk about. As I mentioned to you, would love to host you every quarter because you have so much insight, not only from the mortgage and banking, but also overall economy. You have a great analysis on what to expect from the Fed, commercial, resi market, unemployments. So I really wanted to first start with how do you feel today about the economy, right? So let's talk generic and dive into some of the interesting topics that come out of Trump administration, FHFA, Fannie, Freddie. So a lot of things going on. I'm personally confused because I'm hearing contradictory views of a lot of things, and probably I'll argue with you for the first time on this podcast. So let's start with the economy. Let's go there.
There's nothing like healthy dialogue as long as we both have the emotional intelligence to just be like, hey, it's okay. Like, I don't need to let it affect me. Well, thanks for letting me back on here. I'm glad we bumped into each other at the IMN MSR conference yet again. And you're like, hey man, we got to do the podcast again. I'm like, I love your podcast. It's like, it's refreshing for me to come on here with you because I'm getting outside of the normal stuff that I do in the resi space. It's funny. People generally, right? Just generally, like this, just talk human nature, right? If we're going to talk emotional intelligence, EQ, people climb a wall of worry. Like there's no bull market that just everything's great. There's no problems. Let's just go. Like, if it gets euphoric like that, that's usually when it's a top. We're not even close to that, man. Like we are. I was listening to Professor Jeremy Siegel on a CNBC clip. He said he wanted to write this book about the economy doing well and the markets tend to be bullish, stock markets. And where he worked is like, you can't like bearish books sell 5 times better than bullish books. And that's a reflection of like our lizard brain, our amygdala, what's lurking around the corner? Is there a saber-toothed tiger? Am I going to die? Like, fear, And so we just climb a wall of worry. And there's nothing wrong with that because if you do that, you won't get hurt, and you can make a great living operating that way. I do think fortune favors the bold, and that means taking risks, and that means, either going around the wall of worry, climbing up it quickly, smashing through it. I'm no Elon Musk, but that guy is like building walls on Mars, right? So, I think generally things are good. I think what's kind of, there's a couple dynamics here, right? Just broad macro. Earnings are working. Okay, so companies are reporting in earning money. Okay, and so like we could get into like, well, and analysts lower their guidance, so then of course the bar is lower. Okay, but then they raise them. I mean, Nvidia, as the day of this taping, they're actually probably announcing right now. Like we probably should be watching. Like,
It's all right. Go wait.
We're gonna make it. Okay, so I didn't realize that we taped this, but so did they beat? Did they have 72% profit margin? If they're at 71%, is that a miss? If they have 2 years of back order, is it a miss? And so analysts, they kind of move things around, move the goalposts. But generally, companies are earning money and the economy is growing. And so what's interesting about GDP data is it is a little distorted with the tariff kerfuffle. Like, okay, we pulled through a bunch of goods because we wanted to import a bunch of stuff before it got too expensive, which made GDP one quarter look high. And then the next quarter is slow because we pulled through the quarter before. And then we're like, okay, well, where do tariffs land? Like, it's not nothing. But I mean, just the other day, like Switzerland, got like a 10%, 15% decrease. We're decreasing, coffee and other foods and imports. And, so like, where we thought it was in April, we're doing much better than there. And so just broadly, things are good. So in our business, rates are low, but they've been trending lower, especially since the first Friday of July, when like there was not only a bad jobs report, but then 2 revisions back were bad. And it's just been trending down to softer labor data. So that points out the other thing. There are people who are not doing well in this economy, and I don't, and people have mental problems. It's the holidays, and people, you can't be happy on Thanksgiving and Christmas and Hanukkah. It's like this day I'm happy. So there are real issues in this country, and it's a lot to handle. And man, I could just, I try and just do as much as I can and help people and help give people words of encouragement and say this too shall pass and have some faith and, focus on your family and focus on what you control. And we could say all that, but it sure is fun to talk about all this stuff in our business. So I'll let you, I'll
Yeah,
start it with that.
definitely. Well, yeah. So let's dive in. I completely agree with the assessment. All right. So what you mentioned about the economy, we have great earnings. Stocks are going up, but they're doing more with less, right? So they're letting go staff. We heard about Meta, Microsoft, and other companies cutting staff, significant numbers, Amazon, and a slew of other firms. So you would think that unemployment will keep ticking up, and Feds are sort of operating blind by just catching up on the data from the government shutdown to make their decision in December. Everybody is expecting a quarter point to half a point cut, which tells me they're worried about the labor market, right? So is that kind of what you see? And I really wanted to tie that to affordability as well, right? No jobs, can't buy a home.
There is nothing more deflationary than when your income goes to zero. So 26%, I believe, of all people who are without a job have not had a new job for 27 weeks. That's over half a year. So that's pretty soft. And so, the Fed is notorious for, being late to the game and everything they do. And, like all of their data reports are like 12-month indices. Like they're looking at data from November of 24. What's that got to do with the price of tea? And what's that got to do with the price of tea in China? Right. So like they it's hard for them to look at just today's data. And I get it. They don't want to overcorrect. But labor is weakening. And so at this December 10th meeting, I fully expect another 25 basis point cut. But I think it'll be a hawkish cut because, the board is divided. They are worried about inflation, which seems to be stuck at the 3% level. Although if you look at true-flation data, which is like in the moment today, like rents for new apartments have gone down each of the last 3 months. But the data that the Fed looks at or says they look at, of course they see that, but they're looking at stuff from a year ago when it was going up still, which is still in the average, right? So you take this 12-month average of increasing rent, not as much increasing rent, not as much flat, now negative. And so today, when labor is tough and prices are actually softening today and rates are coming down, making borrowing costs less expensive today, they're looking at stale data. And so, the board is divided. The Fed has never been this divided. And it was divided, because labor, inflation, it's always labor over inflation right now.
Sure.
Right now. But every other meeting, every 6 weeks, they do a dot plot, the summary of economic projections, which is, they're never right, but this is kind of what they're thinking in the moment. Well, we didn't have one in October. We had one in September. And in September, they said they were going to do another 25 basis point cut this year and then 25 next year to get to the 50 number you just mentioned. And then they'll stop. I don't know where the neutral rate is, but I can tell you it is hard for them right now because of the government shutdown, the Bureau of Labor Statistics, which puts out, the establishment survey, the household survey combined together, you get your jobs report. They just said today, officially, we are not doing October. So they're going to get, so as of today's recording, they're going to get tomorrow, Thursday morning, they will release the September jobs report, which is really information collected the second half of October, the first half of September, and then the first Friday of October, they put it out. Well, they're going to put it out, tomorrow on, the 20th of November.
So they have an out, right, Kevin? They have an out. They can say, we don't have enough data, so we're not cutting rates.
They could say that, but it's not. So each Fed board has their own region, and they have data in their region that isn't Bureau of Labor's. I mean, look, they're spending $3 billion on a new building in DC. Like, they can collect data, right? So maybe they don't have the BLS reports, and they're not going to have October because the BLS said we're not going to do it. But I mean, have you ever heard of Revelio? No one's heard of Revelio. And all of a sudden they put out this data because, the BLS is gone and people look at their data showing it's weak. Goldman Sachs has their own data. ADP has data. It's been showing, so it's not like there's no data. So they could use that as an excuse to be cautious. But, if you're really worried about, labor softening, and you think that lower Fed funds rates, which takes time to matriculate into the system to become cheaper borrowing costs for small businesses, which provide 55% of all jobs, or people who are homeowners, locking in a lower rate, lowering their debt services, there's more cash, for the people that are working, can't do a refinance if you don't have a job. So, it does matter on the margin for them to cut. But I know it's very divided whether they will or not at the December 10th meeting. I think they do it.
Yeah, I agree with you. I wanted to argue a little bit with you just as a counter argument.
I love arguing.
But yeah, there you go. Maybe
NVIDIA
we'll come up
beat,
with
by the
better
way.
ideas.
NVIDIA beat.
Sorry?
NVIDIA beat. They're rallying.
Wow.
Of course
This
they
is
beat.
great.
They always beat. They've beaten 9 quarters in a row. So
All right. We have to touch on the AI bubble, but first let's do first-time owners, right? So one of the videos that you put out, you say that rents are coming down, as you mentioned. Prices are also coming down, right? So prices are dropping. Today, I saw First American report that for the first month, we started to see appreciation. So I guess we turned it around in October, and I guess correction is over, or maybe not. I don't know how to read into that. But most important, the NAR's data showed that the first-time home buyers' average age went from 33 to 40. Yeah, 40 in what? In 5 years?
Just a couple years since the peak at 21.
So MBA jumped on it and said, we don't believe it. Mark Franconi jumped all over it and says, I have no idea where this data is coming from. So do you believe NAR or do you believe Mike at MBA? It seems like a lot of, it's jumped too much, probably because they don't have much data, but, what's your opinion?
Well, Mike Frattantoni.
Frattantoni, yes.
Yes, he's a friend of mine. He is chief economist over there at the Mortgage Banker Association, which, we're our lender, we're a private lender, we're part of. They get their data from different sources. I am not knocking NAR. Okay, so the National Association of Realtors. Okay, I'm not knocking them, but they have historically tended to be a little more like rose-colored glasses. Okay, so their constituency are realtors. So I don't think it's in their best interest to give out worse news, right? So unless they're trying to shape the Fed's policy, which, I don't know that they're going to do anything there. But so it is more expensive to buy a home. Home prices have gone up. Rates have gone up. Insurance has gone up. Taxes has gone up. People's wages, if you're a job stayer or even a job switcher, if you're working, has definitely, let's call it 4% wage growth. Okay. So it's growing, and that's higher than 3% inflation. So by the numbers and by the book, people's wages are keeping up with it, and they should be able to afford it. But we had, like 40% or 60% in some markets home appreciation in a matter of years. So what I'll say is that if you're younger, it's harder to save even 5% down. 20% down is a myth. You don't need 20% down. Hope no one still believes that myth. You only need 5% down, 3.5% on an FHA loan, which can be a gift. And if you're a veteran, 0 money down, USDA loan, 0 money down. So get all that out there. So it is harder to get into a home, and there's less affordable homes. It's not like D.R. Horton and Lennar, number one and a distant second, number two, but still huge. Like, they're building houses, but they're not building $300,000 houses. So there is the existing home market with a smaller price point, maybe a little further outside of town, is more the starter home for a first-time home buyer. And it is harder to come by. Lower rates cures a lot. And so, but lower rates, doesn't discriminate. So someone who is older and more savvy with money, they're like, hey, I see this. Like we purchase money business in October was up 30% year over year last month. Okay. So that's not like, I'm young, I'm a first-time home buyer, I'm trying to get by, I'm trying to save enough for the down payment, rates are low, let me go take advantage of it. The people who are more in a position to take advantage of it are repeat home buyers. Boomer wealth in America is insane, over half of our wealth. So first-time home buyers are still troubled. There is an issue with, I would say affordability. Lower rates cures a lot. And so, I like that maybe we've seen the bottom of slowing home price appreciation. I think only 1 or 2 months this year did we actually see negative home price depreciation in a month over month. But the 12-month average is still appreciation. It's just appreciating much slower. But then, boom, 1 month, you see a 0.8% uptick. So, I'm bullish on 26 for that. And why wouldn't we want, 63% of America that's a homeowner, why wouldn't want their biggest asset to appreciate? Stronger balance sheets, plus if the stock market goes up, they have that wealth effect. Unfortunately, unless we have, more existing homeowners that age out, which people are living longer, and sell the lower price point homes that they've been locked in for a while at a low rate, I don't see a lot of affordable homes being built. It's mostly a supply issue. So we need 3D printed housing, manufactured housing, modular homes. And I'm even seeing RVs make a little bit of an uptick,
Tiny homes, right?
Tiny homes.
Yeah, that's what Elon Musk wants to manufacture. Tiny homes. In fact, I think he lives in one, no? He has one.
So.
Well, let's see. So for people that are not qualified to get a mortgage, what do? They try to look at the private credit, right? So there's call it shadow banking or private credit banking, where some of the guidelines are twisted a bit. Some of the, time that it takes to get a loan is a little bit easier. Some things are waived. And we get to the point of 3 major bankruptcies in the past couple of months: Tricolor, First Brand, and Primal Land, where it's all related to auto lenders. And our mutual, client, friend, Jamie Dimons, comes out, and he's the only one, by the way. When I'm talking to Chase guys and JP Morgan guys, I said, listen, how come he talks anything that comes up to his mind? And they said, we're not allowed to talk. Only he's the one that's allowed to say whatever he wants. So he comes out and says, yeah. So he comes out and says that, there's a lot of cockroaches on the market. So what do you think of the pest control, and when do you think we'll get every little cockroach out of the private credit?
So, Dodd-Frank didn't just reshape all of residential mortgage lending. We have what's called a qualified mortgage and a non-qualified mortgage, right? So the former subprime loans are no longer called qualified. So they're not allowed to be bought by Fannie, Freddie, and Ginnie. So all this private credit, these private non-QM lenders, where they take all the risk, and they got smacked in March of 20 during COVID. Like that market froze up, right? Same thing in commercial. Same thing in private credit lending. Okay, so Tricolor, these auto parts stores, if they cook their books, and I like watching Kramer, on CNBC sometimes. He's like, yeah, Jamie and his comments. I love Jamie and this and that, but you know what? Sometimes you just got to admit you got had. You know what I mean? So
He's good.
they got had, right? And so Dodd-Frank, made it for banks to do lending. You had to have perfect credit. But if you don't have perfect credit, you go to private credit, right? So you get the high yield market and all that kind of stuff. And, it's a $3 trillion market a year. Like Blue Owl, they're seeing some problems with some of their funds. They have a couple funds. One, no more redemptions if you're in that fund. And then one, they're actually, I think, shutting down. So, private credit is a risk. And so do I think there is at least one more cockroach out there? Yeah, I do. I think there's probably one more cockroach out there, and it will probably show up. Now, what will happen is if it is a ripple effect that causes stress and market dislocations, you think the Fed is sitting around waiting for labor data? If that happens, they could cut 100 basis points overnight. I mean, so that's been their thing. Okay, so their thing is, market dislocation, orderly. Like the banking crisis that happened in March of 23. They're like, we didn't need to step in. It was very orderly. Signature Bank and First State Bank and all these different ones that went out of business.
Silicon Valley.
Silicon Valley, massive banks. And they're like, it was orderly. So, so what's a $700 million loss to Blackstone or BlackRock, whoever had the money behind that? They may recover 50 to 65% of the assets. They got to go like source auto parts and like find a way
I hear
to
it's north 15 billion.
How much is it?
15 billion, north of 15 billion.
For which one?
Across three.
Oh, across all three, yeah. Yeah, I mean, like
related to the swaps, related to the mezzanine finance,
yes,
related to the funds, and at least two of my clients, which I cannot name, lost at least 100 million each.
And if you bring the swaps part into it, which is insurance betting on a loss, right, or protecting against a loss, yeah, insurers have risk, right? And so I'm not trying to make light of it, but like, what's 15 billion when we have 38 trillion in debt? You know what I'm saying? Like, like I'm not saying it's nothing, and I don't want to make light of it, but is there a contagion, right? Like you remember when Kramer was like, they know nothing. He's pounding the table, because they had no idea the intricate wiring of the tranches and the sub-tranches and how mortgage-backed securities and collateralized debt obligations. And then of course, you go all around the world and who's holding what paper, and you credit your balance sheet. When do you have to mark to market? When do you have to recognize a loss? What does that do with the rest of my business? We've seen that in commercial, right? We've seen that, with write-downs. We've seen that. I will say residential is in a pretty good spot. Like we're in a good spot. And to tie it back to Jamie Dimon, he's a great steward of capital, right? They're sitting on like $1.2 trillion of cash and cash equivalents. They're good. So whatever.
For him, it's a cockroach. For some of other folks that have a heavy exposure, I think that's pretty detrimental.
Management, baby. You got to manage your risk. Like don't bite off more than you could chew. Cash is king. That's
right. And hedge with MSRs, right? That's what the messages on the MSR conference we attended. So very interesting. So let's talk about other cockroaches related to AI, right? So NVIDIA exceeded expectations. They're probably up right now after hours, right? Is that what you see?
It went up and now it's starting to come down. So buying the rumors, selling the news. I bought. It's funny. I I don't gamble, but I kind of gamble. I trade. So I bought a strangle on the S&P at 66.30. So all your audience can hold it against me. I bought 3 puts above, about $10 above, and 3 calls $10 above, and 3 puts $10 below. And so they expire by the end of the week. And so what I want to do is whatever the initial reaction when the market opens tomorrow, I want to sell that half. And then depending on how far away it's moved one way or the other, then I may, if there's enough spread, I may just close the whole thing out and walk away with like a little bit of profit. Or I may then double down on the other half and hope that we get a rebound. So, we're talking about risk management. I'm gambling on strangles.
We don't, disclaimer, right? We don't encourage people to gamble on stocks.
I am not a financial advisor. I am not responsible for your losses, only your profits.
There you go. And nearly 10%, right? That's all you have to pay if you win. But let's talk about the AI bubble, right? So a couple of things going on. One is Trump just released it, or I guess tweeted, X'd, I don't know. Can you say X'd?
I guess still say tweet. It's just tweeted, rolled off the tongue.
Yeah, so we need to take away the AI regulation from all the states because they might be different. We have to consolidate all the regulation at the federal level, create the laws to promote AI as the sort of a lab of AI inside the United States. We have to make cheap energy for AI, et cetera, et cetera, et cetera. And I think he's a big proponent of pushing AI into the United States and creating, or I guess removing some of the legal issues that can prevent people from opening AI companies or doing something with AI. So that's should really drive the stock market up. Now, everybody's now coming out and saying, well, AI is really a bubble, right? So the guy from,
Sam Altman.
Sam Altman was one, but
Oh,
the
Michael
guy
Burry,
that
the
was
Big Short. He had some.
Michael
Yeah,
Burry, put a $1 billion put on NVIDIA. And the guy
By
that
the way,
was the chief
unless he
architect
already
in
closed
Meta.
out earlier this week, he's losing his ass. But go ahead.
Yeah. Okay. Interesting. So don't listen to him anymore.
No, he was just pumping it to get more. Trust me, when these guys come public with their BS, whether it's him or Ackman or whatever, they're dude. They're not stupid. He already made his money.
Yep. So I completely believe in AI, right? So that's the other side. I'm a practitioner. I architected, designed. My TPR firm is the only AI-based TPR firm that's rated by all rating agencies.
Love
it. 95% of the data extraction I do with AI. So my underwriters are all looking at the files, and they have all the data on their fingertips, and they click, and they have a proof of concept on a PDF viewer, so everything's great. I know how AI works. We use 14 technologies. All of that is real. So I am a strong believer that the AI is real. What worries me and why I don't sleep well at night, if you trace back for the past 3 weeks, Cloudflare was down, too much traffic. I suspect it's AI traffic. AWS went down. GitHub went down. Microsoft went down. You just don't have a good infrastructure in place right now to sustain 10x traffic for across the internet connections. Data center speed of build out is not enough, right? So with everybody diving into the AI, and I'm venting, I don't know if you disagree with me.
No, I love it.
Yeah, they do a 10x traffic. We don't have the right infrastructure. Things go down. And if you rely on AI as your primary support structure, or AWS, or Microsoft Azure, or whatever it is, and the cloud goes down, like one of my companies is on IBM Cloud. It's the second time it goes down. Why? Whatever the excuse they have, right? I'm scared. I'm scared that we're going to AI with no infrastructure in place. We talk about it. It's cool. It works. But we don't have the infrastructure. That's why NVIDIA is going up. That's why the data centers are going up. That's why the investments is going up. That's why Trump wants to unleash the funds to build the data centers. Other than that, it's not a bubble of AI. It's the heavy investment into chips and the infrastructure. Otherwise, and cheap energy. Otherwise, the AI is just, you can't support it.
Well,
period.
That's a lot to unpack. By the way, what I worry about the most is in all of my travels is some a-hole with a drone blows up the plane I'm on. Like, so and just so you're like, we all got 1,000 problems until you have a problem with your health, and then you got one problem. So like, I'm feeling okay. I managed to sneak through all the travel this year and no issues. A little TSA, government shutdown, air traffic control. Okay, we survived. AI. So I like that. I like that the administration is trying to say, okay, states, you're all trying to do all this stuff, but here's the governing regulation. And if it is what this administration has shown, hands off enough to let companies continue to develop, like we're still very early in AI. Like what I find with regulation, especially at the federal level, is if it's too constrictive, what you do is you just have a couple winners. So like you've got Meta and you got Google that became these massive winners because of regulation. So new entrants can't get in. I mean, there's no way anyone's catching up to them in their core businesses, right? And so then they get so big, then the government sues them. By the way, Google won their case, their antitrust. So then Apple said, okay, we may use Google Gemini for iPhones. Notice iPhone has not picked a winner yet for their AI partner. And then Meta just won a case, so they don't have to spin out WhatsApp and Instagram. So I in our business on the retail resi side, when the CFPB is getting gutted right now, they just named a new potential person to take over the CFPB. They haven't done they've done some enforcement actions, by the way, this year. People think they've done nothing, but they've vacated some cases, and they said we're not going to go after people for this. They've tried to fire 1,400 people, but it's all held up in court. And now they're saying the Fed doesn't make any money, and the Fed funds the CFPB, so we can't do anything to the CFPB because there's no funds because we're getting it from a place that's broke, the Fed, which I find funny. So then because the CFPB at a federal level isn't stepping in, our industry has been talking for a year, oh, well, the states are going to step in and they're going to overregulate us. Hasn't happened yet. Okay. The states are broke. They don't have money. They don't, but they're hiring people from the CFPB. So they're coming in. So maybe next year it'll happen. Again, less than feared, less than feared, less than feared, less than feared. So I don't mind the regulation if it spurs innovation, because that is our strength as an economy. Every other economy is doing poorly right now or treading water, and we're growing. And at least 1% or more of our GDP is because of the AI trade. And we haven't even started talking about quantum computing. These quantum computers are going to come out and wipe out thousands of NVIDIA's chips compute power in like a millisecond. So that's a whole nother thing coming, which does actually kind of like promote the AI as a bubble thing, right? They're spending all this money on data center build out and all this money on chips and all this money on energy, which they can't do all of it fast enough and don't have enough of it. I mean, China kills us in energy, but they're just not innovating. Like the U.S. innovates, China duplicates.
I don't know about China doesn't innovate.
China duplicates, and Europe regulates. So no,
Sure.
of course, China innovates, but they steal a lot of our intellectual property.
They build on top of our stuff. Yeah.
Yeah, I mean, no one can. It's undisputed that NVIDIA is the king currently of the AI universe. They're the center of it, right? And so they're just out in front of everyone. So I understand what Michael Burry said, and it's a very good point. If you buy an NVIDIA chip today, and on your books, that CapEx that you spent, that capital expenditure you spent, you're depreciating that over 3 to 6 years. But you actually, in reality, replace that chip in 1.5 years, or 2 years, or maybe 3. Okay. Does that credit your balance sheet? And so what I think it does is it shortens the runway. I think his point's well taken from a financial review standpoint. It shortens the runway on how much sooner you need to get ROI on these, like literally over $1 trillion in spend. I think it's like, so like, well, the way I read it is like, there has to be $500 billion a year in revenue to come from all these companies spending all this money on capital expenditure build out in this AI trade. Will they get it? I mean, they're not going to get it if Apple's like, well, they might. Like for Apple to get it, I heard the number yesterday is they just got to charge $35 more a month for the AI, whatever AI winner they pick. So that's why they're taking their time to make sure. They have 2.5 billion devices, 1.25 billion iPhones globally. And they have not picked Gemini, Perplexity, OpenAI, or build their own. They're taking their time because they have the installed base. It's the same thing with your company and my company, although you build tech. I have all these AI companies who want to come like, oh, we got this AI thing. They need us. We're doing 12 billion or more this year in mortgages. We have over 1 million contacts of people we've ever been in touch with. So like we can afford to wait too. And we can pick a winner because we have the installed user base. I'm not trying to compare ourselves to Apple, but every lender is like that. So Apple doesn't have to pick a winner yet, but someone somewhere has to get ROI on all this spend, or else they have to reduce the spend, or else grow earnings, or else the price to earnings ratios don't make sense, which is the point Michael Burry made. I don't think we're there yet, but it is a point that people are looking at. And so AI, is frothy, but man, I feel like, I mean, the stuff, I had a conversation 2 weeks ago with Snoop Dogg and Mike Tyson. Literally, like there's a company I'm invested in that licensed out. So like, think like Spotify or SiriusXM or like, any of these companies that like, they did licensing deals with celebrities. So their stuff doesn't get put all over the planet. If you're going to use my AI name, image, and likeness, and you want to have a conversation with me, it's going to be through this official place where I license all of my IP and my name, and then you go here. So it's called Backstage. It's pretty cool, right? And so imagine if you and I were able to put, my father passed about 5 years ago, take every recording I've ever had, I upload in there, and I can, like, in a moment where, like, my son called me. I knew how to handle it yesterday, but he called me yesterday, my 8-year-old son. I just have 4 kids. My stomach is hurt. My stomach, I knew how to handle it. It was fine. But let's say, like, I didn't know how to handle that. You know, I could go to my little AI thing and have a conversation with my father. Like, Dad, what did you do when I did this? Here's my advice, son. Like, stuff like that's pretty cool.
That's scary. It's cool,
Economists,
but scary.
economists, celebrities, actors, sports athletes, people that are no longer living. Like, I don't know how that monetizes and where it goes, but, like, we can't even begin to imagine where AI is going to be in a year from now, much less 5 years from now. So when those chips depreciate on the balance sheet, my guess is there'll be more ROI and more revenue. OpenAI, different problem, only $4 billion in revenue. They have $1.4 trillion in circular spend out there. I'm a huge fan of AI. I still think it's early. I'm not calling it a bubble, not yet. But if it were to be a bubble, it'll be just like the .com, right? So we're in the 1999 phase. We're not quite in the 01 phase, but there will be just a few winners. And my guess is the companies with the biggest balance sheet, by the way, Meta taking out a $4 billion loan, like, is a drop in the bucket to them. But, they took out debt. They're not using profit to spend on CapEx. Punish Meta stock. I'm buying that dip. But, when does it, like, earnings grow, CapEx increases, in everlasting increases without any ROI or earnings to show for it? But for now, earnings are working. They're growing. So I don't see a bubble. It could be a little frothy. Certainly a wall of worry to be concerned about. But I think we're still good for now.
I can comment on what you said. About 50,000 startups related to AI are born every year. 95% close next year because they sell freeware that's available on OpenAI or available in Gemini, and they show proof of concepts. The clients or whoever they pitch to, they get impressed. When they get to nitty-gritty with all the corner cases, they fall apart. That happens every day.
It's like a restaurant.
Yeah, it's. I've been pitched so many startups. The demo looks great. Proof of concept looks great. You start working with that company. Oh, but we didn't know that. Let us build it, and this and that, and it becomes a 2-year thing. But one thing that I found working with lenders, so we announced a few lenders that we're working with. I'll give you an example of Longbridge Financial, guys. It's an Arlington company.
Those guys.
Yeah. So they used us to integrate AI in application group, closing group, bidding group. So they underwrite a loan while they bid when it's still, up for bids with other lenders. Post origination QC, CPR, and HAMDA and onboarding for the servicing. So this is a common layer of digital transformation where we grab the data from the same documents on the same channel, and then we use it in different applications. That's the power of AI. That I believe it. Very mathematical, deterministic. You cover all the corner cases. You have to be a subject matter expert like you, right? You don't just pick somebody that is, knows the stuff, great with AI, shows you AI app and say, wow, this is really cool. Let's try it. Poof, falls apart, right? So very, a lot of promise, but it takes time. And the biggest hurdle that I stumbled on is not the tech. It's the human adapting the tech.
Mm-hmm.
People don't want to change. Somebody that's in our industries is probably average age is 45, 50 years old. They don't like tech messing around. They don't want the tech taking their job away. They will do everything to prevent tech deployment in our industry. So that's my vetting. And I'm just, I can tell you as the first point that we covered, unemployment, for the right implementation of the tech, you only need 1 out of 10 jobs in the middle management and data entry and white collar jobs. 1 out of 10, if you do the AI implementation correctly. Mm-hmm. That's why everybody's laying off, because they already implemented that. They see the power. They see the scalability with AI with very little staff. So they're adopting, but that's life, right? I don't know how to solve that. I'm worried about huge unemployment numbers, but only when the adoption happens.
Well, can
You're right.
Can I give you my spin? So
go.
So, we've had a lot of innovation in our country, railroad, electricity, smartphones, and the labor force just keeps growing. So there's something to do, right? So, so I think AI will, yes, it will displace jobs, but it will also create other opportunities in other places. It is harder for someone that's older, like who's done this one thing their whole life, and now they're like, okay, I got to reinvent myself. But we're so resilient as a country, and I do think that people will find a way. It's just figure it out. Now, I have been with PRMG over 15 years, and as a partner, just about 10. And 9 years ago, this coming January, I signed a contract with Salesforce for Speak of Longbridge. They do a great job. They take care of seniors with the HECM reverse mortgage program. It's fantastic, right? We have a partnership with them, and in our HECM division, we built out this kind of pipe work on Salesforce, and then in our wholesale and correspondent channel, we have about 65 account executives, B2B salespeople that use Salesforce. So we built it out. It's Salesforce, great. Everyone knows Salesforce. Fantastic CRM. You get what you put into it. I was invited right after I signed the contract to the inn at the Presidio, right under the Golden Gate Bridge, right there. And from me to this wall is Mark Benioff in a fireside chat with the Wired magazine editor-in-chief. They said, and I'm sitting right there on the front row. I came in late, so I got the front row seat. It was great. They said, this is 9 years ago, when 45% of the world's jobs are automated, what are we going to do about it? And it really hit home with me that there's some corporate responsibility for those of us, because AI to cut costs is actually very easy, right? So that's where a lot of people are starting, okay? And so I'll give you an example of something we're doing and how that corporate responsibility resonated with me. So in our retail channel, we have 650 originators, and they're local, they're in the communities, they make calls, they do a good job. They're about a third of our company's business. And so we are going to implement agentic AI. We're in the process of it right now. And so I kind of separate agentic AI. I say AI voice, and then I say agentic AI, which is kind of like the texting and collecting documents, all stuff. I could do that one first, and out of our 150 branches, I could save a processor here, I could save a loan officer assistant here, and so 5,000 here, 5,000 here across 150 branches. That's real money every month. Okay, I could do that today. What we decided to do was do AI voice first. Okay, our salespeople are commission only, so we're going to implement AI voice to help call on our past 800,000 million contacts and set appointments. Okay, loan officer, you're tired today. You're not motivated. You don't have discipline. You're new. You don't know what to say. You don't have the database. You're not following instruction. You're maybe a bad hire. Maybe the bot, it's like bomb 20% bad hires. This bot will convert, doesn't get tired, discipline, does a fantastic job, sets an appointment either in the calendar or does live transfer. So now, if instead of saving 5,000 here, I can maybe add 20 to 50,000 in revenue per branch right here, load these people up, then come behind them with the agentic AI to give them a lift. And so that is a purposeful, intentional decision we made not to cut jobs. And so that's why we're doing AI voice first here. And so I say that on every podcast I'm on because I want people to listen, because it isn't just about cutting costs, because math is easy, right? And we are doing more with less. So in our peak month in 21, we did $1.75 billion in a month in fundings, COVID, zero Fed interest rate policy, with 2,900 employees. Last month in October, $1.4 billion in loans, paid principal balance, with about just under 1,400 people. Now, it's not as much money per loan, the margin's not there, but we did more with less. And so, and we were very, there's only 4 of us that own this company. So we're not hedge fund like or home, or equity firm like or bank like or insurance company like, oh, mortgage people. We are mortgage people. This is our family. So we're very slow to fire here. We're very loyal to a fault. And so we held on to a lot of people, in 2023 and 24, second half of 22. And it bore fruit last month, and that was great. And so these are decisions that companies have to make on how they're going to implement AI and tech. And that's a real life example of how an owner and my partners in our company and senior management made decision to balance how bad it could get for AI. Now, I can't speak for all the other companies out there. I don't know what they're going through, but I read the headlines too. And so I still think, AI is a force. It's a weapon that can be used for good, bad, or ugly.
This is so refreshing, KP. Really, so refreshing. You put such a positive spin and the direction for a lot of lenders to follow. Because if you look at the origination cost, 50% of origination cost, which is about $11,000 per loan, is attributed to marketing and sales. So you're attacking the biggest piece to reduce that first before you look at the easy stuff.
Buddy,
Phenomenal.
let me tell you something. Let's just say $12,000 is the average MBA assessed price per loan. 9,000 of it goes to salespeople. Okay, so that's been a challenge, right? Like, and look, our originators go out and they hunt and they do all the work and they find the deals. But if we can help them do it with AI a little easier, help them scale, maybe they can work for less because they're doing more here, which means better pricing for the consumer and more money net total for both the company and the salesperson. And so it's a win-win-win all the way around, right? I hate to use a cliche. I looked at a tech company. It's called Cindy.ai. So a buddy of mine used to work here, went off on his own, does great. One of the biggest producers in the industry, a guy named Ben Anderson. He, in October, had 263,000 text messages. It cost him, I think it said it cost him about $1,100 for all the compute and all the texting. He got 240 people to reply back. This is old leads. He's been in the business a long time. 27 loans funded. On $1,100 spend, $289,000 in revenue.
What are we doing here? Let's.
You know what I'm saying?
Yeah. Let's open our company.
Well, I'm just saying, like,
margins are great.
So imagine doing that at scale, and you're helping, the companies that are helping their originators do that. And then that gives more business for their operations team to work. And then you come behind them and you give them a lift. I think there'll be some winner take most. I mean, you look at Rocket, they're spending a lot of money on AI. They've done a lot.
UWM, direct channel to Google. Oh, yeah.
Freedom. So you look at these top lenders, it's a winner take most. And if you look at AI and you see the circular stuff going, it's kind of going there too. I think with AI, it's finally starting to trickle down into other businesses. So, it's part of, the business cycle.
All right. We have a few minutes left, KP. I know you have to run. What's the final words on 2026 and December? Because I'm worried, but you're going to say that, don't worry, everything's fine. Let's be positive. Santa Claus rally is coming and, rates are down and, I'm listening to your positive spin. This is, by the way, this is the reason why I got hooked on you. You always have a positive spin. During COVID, I was so down. I listened to you and Kevin, thank you. You kept me up. So what's the positive spin unless you are negative?
Well, I am unsurprisingly positive. So, lower rates cures a lot. And, I hear, I'll give you a little negative, this K-shaped economy, right? The top 10% of wealth in America spends 50%. Okay. And so, consumer spending is still 70% of our economy, right? The bottom half of our economy is struggling. How do we lift them up? You got to give them a job. You got to get them working. You have to have, employment opportunities. And so the Fed lowering the rates and having small businesses, especially, have, cheaper money to fund their business, that creates that opportunity. I'm very positive on that. So as it comes to rates, we might not go that much lower, right? But rates are in a good spot historically. Mortgage interest rates, if the Fed cuts 25 and then maybe another 25, I don't see a recession on the horizon. So that's been, we've been on recession watch since our last recession. And, got to get the Fed credit. I mean, they've engineered a soft landing. doesn't last forever, right? So I'm positive that 26 is a growth year. It's not going to be without headwinds. It could be choppy, but I do think that lower interest rates, lower costs of capital, it does help a lot. And so I'm positive going forward. Again, it's not a hockey stick straight up. There are people that are suffering and struggling, and we have to help them stay gainfully employed. And I think inflation is not talked about as much as the labor market, at least from the Fed's perspective. But like everyone's like, oh, inflation's slowing down. No, it's just going up at a slower rate, but it's always going up, right? And so people are definitely hurting. So employment is the key. We just got to keep people employed, regardless of what AI or whatever comes our way.
And I will give you the promise on this podcast that I will implement the same strategy to my staff. I have 190 people, not as many as you, but 190 people full-time, and everybody else, maybe thousands of contractors. And I will try to find work for every one of them, even though I implement AI in all my 3 companies. So, Kevin, you inspire me.
Love it. Tell your people that. They would love to hear that. They better listen to this. Man, I work for Alex. Alex has got my back. I'm going to work so much harder now. Like, hell yeah.
That's right. Like a family. So, KP, thanks a lot for joining the podcast. Let's talk next quarter, and let's keep the positivity going. Hope AI is not a bubble. Michael Burry is wrong, and hopefully Trump will make energy cheaper and will win the AI war versus China.
Cheers
Thanks
to that.
again, Kev.
Happy holidays, everyone.
Thank you. Take care. Bye.
Bye.